Good afternoon, ladies and gentlemen. It is April 15th of 2024. I hope that everyone had an absolutely fantastic weekend. I know out there as it relates to the stock market, the end of last week was a little bit tough there as we're really now in kind of week three of this really what I would consider a controlled correction in stock market prices. For ourselves, the sectors that we're in, such as energy or emerging markets, some of those orphan growth sectors. We've largely avoided most of the sell-off really until Friday. So Friday was a bit of a nasty day in those sectors as well, even though the price of oil was up. But that just goes to show you at some point in a stock market correction, everything eventually joins the correction party. But what we wanted to do this week is really kind of focus on what's causing the stock market correction. Is it merely a function of an overbought market with healthy breadth and healthy momentum that needs a reset, needs to catch its breath? Or is it the start of something deeper and more concerning, right? So we'll go through all of those points this week. And again, if anyone has any questions, you're always welcome to give us a call and we can go through things in more detail. So let's go ahead and get started. The title of this week's presentation is, how much life is left in the bull market. Now, we say that a little bit of tongue in cheek because, quite frankly, we like the conditions of the markets in terms of a longer term backdrop, but we want to go through everything this week. So the bottom line is we're starting to let off some steam. Whether you're looking at our strategies or you're looking at the market, there's been a good run, and it led off with growth, transitioned over to value. Now we're sort of getting a reset a little bit across the board. We still love the areas that we're in. We think there's a lot more downside cushion in those areas, even if every once in a while you get a day where everything sort of goes down together. Number two, those rate cut expectations that everyone keeps talking about. We've been on the other side of that fence. We have said that we do not see a world where the Fed is cutting six times this year. Why have we said that? Inflation's high. And lo and behold, the data has actually started to show that, and we're going to go through that this week. But we need to reset those expectations as inflation rises and reaccelerates to the upside. And then lastly, oil continues to re-rate. And we don't invest in oil due to geopolitical reasons, but we do think that the reaction to geopolitics is often a symptom of a deeper problem. And in this case, we believe that problem has to do with long-term supply investment into the ground in a world where the economy actually is doing quite well and demand for carbon-based energy continues to rise. So what we saw earlier this week, Wednesday and Thursday, were those first major distribution days. And a lot of this had to do with that CPI report that came out last week where, inflation is suddenly a concern again. And it led to the first 5-to-1 sell ratio. I'm recording this late Friday. Market is down a lot. I suspect we're going to have a second distribution day. So that'll mark 2 distribution days, often a precursor to something where we could get that 5 to 10% correction in the market. Again, completely normal within a bull market. That should not be a reason for people to panic at any stretch of the imagination. That happens, especially after an overbought condition. Another thing is interest rates are up significantly since the beginning of last week, and we were entering into this with overbought conditions. So again, not too surprising on all fronts there. So the question we get then is, okay, well, when would you go and buy into a stock market correction? Well, the first thing we want to understand is what were the market conditions preceding the correction, right? Where was the correction preceded by healthy bull market conditions, or were there signs that the bull market was getting tired, right? So the things that we look for are strong breadth and strong momentum in the right areas or corners of the market. So we want to see broadening stock market participation. So most of the stocks and most of the sectors are rising along with the overall market, and that's expanding over time. And we talked about that 90% participation rate last week. And momentum in the right pockets, right? So that would include areas like the cyclicals, like energy and the banks and consumer discretionary, tech. those areas. Now, if the momentum's coming from utilities or consumer staples, that would be more that would give us pause, and that would make us somewhat concerned because those are more recession-proof sectors. We haven't seen that yet, but so far, that what preceded this was a healthy bull market, in our opinion. So when do we buy into it? Well, we want to wait for when we experience a spike in those 20-day lows, right? So when we look at prior corrections and where it made sense to come and step in and put more money to work, was when the percentage of stocks at 20-day lows was in that 50 to 60% range. Quite frankly, we're a little bit early there. Late last week, when I'm recording this right now, we're right around 28%. I suspect that'll get closer to 40% by the end of the day Friday. So we'll have to see where those readings come in. We're close. We're closer than we were early to mid last week, but we still would like to see a bigger spike there. That gives us the confidence of saying, hey, but the foundation of the market looks really strong, looks really healthy, and we've worked off a lot of that short-term froth in the market so we can go in and start picking away. Again, we're not there yet, but closer. And just a reminder, bull market correction risk, overbought with rising breadth and rising momentum. That's where we'd use dips to add exposure like we talked about on the last page. It's really those bear market topping risk patterns where we would say, hey, on any counter trend rally within a correction, we would look to offload some risk. So in other words, we were overbought to begin with, stock market starts to go down, you get a counter trend rally. We said, hey, you know what, going into this correction, we saw declining breadth and weak breadth and declining momentum. We would only use that rally to offload risk. Again, this right side of the screen here, that's not what we saw prior to last week. We really 90% of stocks were trading above that 200-day moving average. So really strong breadth across the board. So why are markets pulling back? I think the most important chart that we can offer you this week is this chart here on the right, which shows interest rate cut expectations. So how many interest rate cuts is the market expecting? We were close to 7 at the beginning of the year, and you can go back to December of last year. We have been very consistent that this is a crazy assumption that there would be 7 rate cut expectations. Now, why did we think that was crazy? Inflation was double the Fed's target. So when you're double the Fed's target and you start to cut rates, inflation is going to stay high. It's simple math, right? So if you make money cheaper and easier and inflation is already high, I guess it's really hard to get inflation down if you're making money easier and cheaper to use. So to us, it just was logic more than anything else. And so inflation does appear to be reaccelerating. We'll go through that chart here in a bit. That means that these cut expectations have to fall. And after Thursday and Friday, I think we're down closer to 1. And I think 1 is probably reasonable. Maybe by December of this year, I would not be surprised if maybe that's even no rate cuts. Maybe even we get a rate hike. That super core inflation is reaccelerating. So again, we're in a different dynamic than we were 5 or 6 years ago, where nominal growth in the economy is strong, and we're in a deglobalization mode where we're competing with China, where we are competing with Russia. We're even competing with the EU in many cases. And so the supply chain benefits of disinflation are largely coming to an end. And so there's a tailwind, a structural tailwind for inflation. And so just going back to this, what that really means is we need to shift out of assets, in our opinion, that benefit from lower rates. So that would include those highly volatile growth assets, and we need to shift into assets that benefit from reflation, such as commodities or emerging markets or value stocks here stateside. That's where our focus is. And you can see here the chart, a picture says 1,000 words. That's super core inflation. What is that? That's the inflation number that excludes food, energy, and housing. Why would it exclude that? Those are really 3 important things in our daily lives. Well, the Fed wants to look at discretionary items. So in other words, we have to eat, we need energy, and we need to live in a house, right? So those are kind of non-discretionary. We're looking at discretionary items that interest rate policy can most likely impact, right? So their policy can have an impact on that. They can't really have an impact on food and energy. And so when we look at the super core inflation, it has swung back up to 4.8%. Now remember, the Fed's target is 2. It's all the way down here. Why would you cut rates when you're over double the Fed's target? And if they do cut, what they're actually telling the market and they're communicating to the market is that they no longer have a 2% inflation target, that they're willing to tolerate 3 or 4%. And I'm not sure that's the message they want to go out there with right now. So very important to see what plays out here over time. But I suspect a tighter monetary policy than most are pricing in right now. And I think we're in the right areas to deal with that. And we're seeing it in interest rates. The 10-year interest rate is back up to 4.2% or so. It's actually around 4.35 now. So again, that 10-year rate is a function of economic growth expectations plus inflation expectations plus the resultant Fed policy that brings. Versus the 2-year is much more tied to strictly the Fed policy. The 10-year can go up even if you're cutting rates, right? I know it's hard to imagine that, but if you're cutting rates and growth expectations go up and inflation expectations go up, you can get a rising 10-year rate. Right now, these two are outweighing the expectations of Fed policy. So interest rates are going up on the long end, which is you're going to see that play out in higher mortgage rates. Now, what's the economy saying? I know so interest rates are up, causing a shift out of growth into value, but value only works if the economy works. So we need to make sure the economy is doing okay to support asset prices for those economically sensitive assets, right? So Dr. Copper, right? Copper is used in a lot of everyday items. We look at copper as a gauge of risk sensitivity, as a gauge on economic health. That's why we call it Dr. Copper. Copper is breaking out, right? So all those bears on China and all those bears on the US, it's hard to see where we're going into a recession when copper is in a multi-year breakout. Just very, very difficult to see that. Oil doing the same thing, giving that same signal, right? Now, oil has more of a geopolitical component to it. Obviously, with everything going on between Iran and Israel right now, there's certainly a risk premium attached to oil. That said, when you combine what's happening with copper, when you combine what's happening with oil, when you combine what's happening in the labor market and U.S. nominal growth, it paints a mosaic of a healthy U.S. economy and a healthy global growth picture. And, the other big thing is when we look at oil, I shouldn't say no one, but like very, very few investors are really enthusiastic about investing in the energy space. Another big reason why we're enthusiastic about it, because the valuations are there. The fundamental supply demand picture is favorable for oil prices. And of course, we look at the valuations, they are dirt cheap. So we really like the backdrop here for oil, little crowd participation that really goes our way for a long-term investment. And then finally, we look at the credit markets, right? So when this line's going up, that's no good, right? That is a sign of rising credit risk in the economy. So when that line goes up, it means the banks are charging more to lend because they're worried about losses on loans. When this line is falling, it means that the banks are perceiving companies and people as being credit worthy, and they're bringing down the credit costs. And so when we see this line fall, that's a positive sign. We're not seeing any noise come out of the credit markets, which again, when you get the stock market pullback and you don't get a follow through from the credit markets, that's a good signal, right? Now that can change, but so far, that's a pretty good signal. So in other words, when we look right now, in summary, we have good signals, a lot of scary noise. It looks like we got the market's got a bit of a cold, right? More than anything else versus a disease. So few takeaways: inflation does remain stubbornly high, something we've been consistent on. It does appear the market has to reprice those lower rate cut expectations. We're in the process of doing that right now. But other than that, we believe the economy looks robust. And this does show the signs of being more of a plain vanilla stock market correction to work off an overbought condition. So That's what we got for you this week, 888-543-3776. Hope that everyone has a great week, and we'll speak again soon. Thank you.